Hello and welcome along to the Property Academy podcast by Opus Partners. I'm your host, Steve McKnight.
I'm Andrew Nicol.
And today on the show, we're talking about I want out. I want out of this flipping nightmare.
Look, I thought we'd spoken about it. We'll go see a counsellor. It'll be fine.
You need more than just professional help. So we've got a case study today from a listener of the show, somebody who has invested in property and is having a bit of a rough time and has said, hey, I want out of this. But just before we go through it, we have just released our audiobook on Amazon Audible. It's called Wealth Plan. Google it, you'll find it. Now, Poppy messaged in and said, hey, Andrew, our investment we got through a particular property investment company, not us, a year ago has dropped in value by about $100,000. We've got a mortgage on it of $690,000, but according to a real estate agent, maybe we could only get $600K if we sold now, and we are currently topping it up by $375 a week. Now, I've heard that interest rates may go up again. The whole thing's making me sick. I want out, but I know that it'd be the wrong thing to do. Do you think it's going to take long to recover those capital gains if once prices start to rise? I want out of this flipping nightmare. Thanks, Poppy. Now, Andrew, I think we might have actually talked about Poppy's situation on the show previously, but just give us a wee rundown of how this has played out, because this isn't the first time you've spoken to her.
No. Actually, Poppy came along to a webinar, I think it was in December last year, and Poppy's not her real name, by the way. That was her stage name for the evening. And
just like how your name's not really Andrew Nicol.
And she contacted me because she bought this property through an investment property firm, set it all up, and then said, oh, look, she felt like she'd been sold a bill of goods. So she bought this apartment in Papakura. It was brand new, 80 square metres, pretty big apartment, to be honest.
Actually, decent size
Two
apartment.
bedrooms, and the advisor she was working with said Papakura is reinventing itself, there's lots of big developments, then settled it, and maybe decided, I think, from our webinars that actually maybe apartments aren't the right fit for her and her husband, and so decided, actually, I've bought a bit of a lemon, but now I'm stuck with it. What do I do? And so I actually had a one-on-one catch-up with her and said, look, it doesn't sound like it's the end of the world. It might not be what I would have necessarily recommended for these particular people, but it was an okay investment.
Well, was Poppy stiffed? Was it a bad investment?
It was pretty reasonable in terms of price for that time. When she signed up for it, I didn't see that it was a bad area. I've got a rental property in Papakura. There were a few things that had gone wrong, which inevitably happens. Like, investing isn't without risk. So if something goes wrong, that doesn't mean you got a bad investment. That just means sometimes stuff goes wrong. So I think the property took about 8 weeks to rent out, and they've now got tenants, but the tenants weren't their perfect tenants. So
what were they?
Work and income beneficiaries, which, look, at the end of the day, I don't really mind work and income beneficiaries because work and income are paying for the bulk of the rent. So I'm okay with this, which is what I told Poppy when we met. But I think the biggest thing was that they'd had this big vacancy period. They'd realised that actually an apartment's not going to give us the growth that we want. We should have bought a house or a townhouse. And so it just felt like the wool had been pulled over their eyes a little bit.
And I think there's going to be a lot of property investors, especially first-time property investors, feeling a lot like Poppy and her husband at the moment, because you are making, in this case, she's making a top-up of $375 a week. That's probably what we'd expect with today's interest rates, given that she's purchased in Auckland as well. And it's more of that emotive side. You know, God, it makes you feel terrible for her when she says, the whole thing's making me feel sick. I don't know what to do. I want out of this flipping nightmare. So, Andrew, given that there are other investors feeling like this, what's your kind of advice?
So I got this updated email just at the weekend, and I emailed back straight away because I appreciate, regardless of the fact that this investor had gone somewhere else to buy their investment property, I think it's really important that people get clear understandings of, you know, what might happen over the next wee while and why you should hold.
I'm actually quite impressed with you. She said this at 10 past 10 in the morning, and you got back to her an hour and a half later. That might be a record. You never respond to my emails that quickly.
Yeah, no, I did get back on track. Because these kind of things, I know you think I'm heartless, a heartless old bastard, but these ones get me. I think, and then I go up to my laptop and tap away for a wee while. But I think, like, when I read this, I realised that, hey, there's a lot of emotions involved for Poppy. At the moment, she's paying out money and the market's going down. Now, I know mentally that's quite taxing. Like, if you're paying out money for an investment that's just losing money day in and day out. You think, when's this going to end? That's when people make the rash decision to sell and crystallize their losses, make those losses really real. So what I did was I went back and I said, look, my first question is, how long do you have to wait for the market to recover? Because I remember when I chatted to that they actually had quite a bit of time on their side. These guys, they're not young, but I think that from memory they're about 52. So they've still got ages before they're going to have to sell this property and put that cash in the bank and use it for retirement. So there's quite a lot of time in a property cycle for them to weather the storm. Now, the other thing is these guys bought this property for long-term capital growth. Now, they've had short-term losses, but that doesn't mean they're not going to get long-term capital growth. And just that morning, I'd been flicking through stuff and I'd come across this article, which I sent her. And I thought, well, look, let's give her some data from someone other than us as well. So the headline was, Westpac expects 8% house price rise in 2024. And look, the article basically said Westpac predicts 8% rise next year, ANZ a mere 3%, Tony Alexander a whopping 10%, and CoreLogic somewhere between 3 and 5. Now, that doesn't mean that this property is going to go up 8% or 10% or 3.5%. It means that the market might start to recover. That's what economists are predicting. But, it's a best guess.
And just thinking about Poppy's situation there, okay, so they're in their early 50s. The thing they've got to do, if they can, is hold on for as long as possible. Because if they sell now, you've got a $690,000 mortgage. And just to remind ourselves as well, they didn't purchase the property for $690K. I think it was $660,000. But there was a revolving credit in there. I think they'd borrowed some money in order to purchase a furniture pack.
I think they did a furniture pack as well.
Yeah, there was about 15 grand. But nonetheless, so if they've got a $690K mortgage now and your house is worth $600K, if you sell it, pay the real estate agent, you're probably going to walk away with $570K. So because you've got a mortgage of $690, if you sell it, you'll get $570. You're going to have an additional debt of $120,000. And yep, if you sell it, your cash flow is going to be slightly better because your mortgage is massively shrunk. But you've got 120 grand worth of debt and no real asset. And I think for somebody who's kind of in their 50s, that's going to be really hard to recover from.
Well, I also, from a mental standpoint, imagine if you go through this process and then you sell the property and you make a loss. You've had nothing good come out of this. You will never invest in property again.
Well, one thing I've been thinking about is, look, in retrospect, you go back, she bought at the wrong time. Now, there's nothing wrong with that. I mean, it kind of is. You bought it at the wrong time. Well, there's nothing wrong with that. But I bought it at the wrong time as well. We all buy at wrong times. You bought it at the wrong time back in 2008.
Oh, well, I buy at the wrong time all the time because I just buy all the time.
Yeah. So you get some right, some wrong. And one other thing I've been thinking about is Poppy bought it the wrong time. And that's okay. It's already happened. Can't go back and change that. I bought it the wrong time. You buy it the wrong time all the time.
Yeah. I buy all the time, so I have to buy the wrong time.
And if you buy at the wrong time, that's okay as long as you sell at the right time. So if she holds on for as long as possible, she can still make some good capital gains. But what you can't do is you can't buy and sell at the wrong time. Because if she bought at the wrong time, sells now, which is arguably bottom of the market, wrong time to sell, she is going to lose that 120K. Now, if you buy at the wrong time but sell at the right time, you're going to be okay. Similarly, if you buy at the right time and sell at the wrong time, you can still make good money. If you bought at the start of the property cycle and then you sell at the end when prices are on their way down, you might not have made as much money as you wanted to, but you can still make good money. Of course, if you buy and sell at the right time, you're really happy. But the one thing you can't do if you want to make money is you can't buy and sell at the wrong time. And if she sells now, that's what she'd be doing. She bought at the wrong time and she would be selling at the wrong time as well.
I think one of the other big things is, as I was giving Poppy the advice over the weekend, is I was basically, saying to her, you need to be able to weather this storm. You've got a really tough situation right now, and I'm not taking away from that. It's a tough situation, but if you can get through this, your future self in 10 years is going to be really thankful you did. But you've got to be able to hold for that 10 years. So I did some really pretty basic numbers on the cash flow. So I had a look at, if you've got a 690k mortgage, it's interest only, and you get a 1% interest rate drop, that's going to make your cash flow better by $130 a week for every percent that it drops. So while we sit here in a high interest rate environment, and I gave her our interest rate forecast, well, we think they might get an interest rate drop of 1% over the next 12 months. So that takes her contributions down to about $200 a week. That's a lot more manageable for someone. And then as rates go down further and further and further, now it might be break even, or even better yet, it might be cash flow positive in, say, 5 years' time. Well, that helps you recoup some of those cash flow losses. But at that stage, as the rates are down, hopefully prices are going up as well.
It's about saying we're going through some short-term pain now, but the long term's going to be okay, and being able to look forward. I kind of think of it a bit like a relationship breakup. You know, even if you know it's the right thing to do, it still hurts for the first, day or two. I like that you said day. You said 2 years. I said day or two. No, but for a amount of time, honestly, people are going to think we really are heartless. But you are right that we've got to look forward to the future and see where we're going, so that we can just hold on, knowing that over time things will get better.
And I think this is a really good lesson for a lot of investors out there at the moment who have signed up maybe at the peak of the market. They're feeling bullish about the market. Interest rates are pretty affordable. Now they're settling and prices are down and interest rates are high. I was having a drink with one of my friends over the weekend who's just about to settle on a property that he did exactly that. He bought at the peak of the market on my advice. He's now settling with the price down and the interest rates up. Now, he's actually pretty relaxed about the whole thing because I've been coaching him that it's okay to have this pain. Now, that doesn't take away from the fact that it's going to be really painful for the next 12 to 18 months because it's going to be high contributions and the price is down. But the one thing that I say to all investors that are in that situation is, over the 15 years of owning a property, say, or a full property cycle, you're going to have some pain. The good thing, the only redeeming feature, is you've got the pain out of the way right today, the start. So you can kind of hope, based on averages, that the next 13 years after the 2 years of pain, it's probably going to be pretty smooth sailing.
And of course, the cash flow is the real concern here. And 2 days ago on the podcast, we released an episode about how you might be able to save money in your personal situation and your personal life so you're able to afford some of these cash flow contributions. But Andrew, what are some of the other things that an investor could do to help weather that storm?
So I think one of the biggest things that I'm seeing a lot of investors do is just kind of redirect where they're putting money at the moment. So if you're making extra payments on your personal mortgage, if you're putting extra surplus funds into KiwiSaver, if you're putting money into a Sharesies account, if you're just spending a little bit more excessively, just winding some of that stuff back for the short term. Again, you don't need to stop those extra contributions to KiwiSaver or the Sharesies account or the extra payments on your mortgage, but just maybe for the next couple of years while interest rates on your investment property are high and you're making higher contributions.
And if you want some more tips, go back and listen to episode, I think it'll be 1437, to get some of those tips about ways to free up cash flow. Or I also think we did episode 1292 about 8 tips to handle higher interest rates. Those might help as well. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you want to listen to that audiobook of our wealth plan, if you want 11 more hours of our sultry voices, then you can just Google wealth plan audiobook. It'll be the first thing that comes up, now available on Amazon's Audible. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight. We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.